Hi there, Adam Thompson here from My Mortgage. Today I just want to cover one of the absolute basics of getting a mortgage, and that's fixed rates versus floating rates. Now, to briefly explain the two, a fixed rate means that you lock in a rate, your interest rate is that amount. So the bank charges you interest, that's the biggest cost of what you're paying back to them. And you can lock that rate, say, for 1 year through to 5 years, and that's what's called a fixed rate. It's fixed for a year, it's fixed for 2 years, it's fixed. Floating, that's basically, it's a variable rate, and what that means is that rate can change. So as the market moves, the floating rate changes. And you might think, hey, in an environment like we've got at the moment where the rates could be dropping a little bit, the floating rate could be the best thing to be on. However, there's often a big difference between the floating rate and your fixed rate. So as we stand here today in July 2020, 1 year fixed rate is 2.55%. Whereas the floating rates are up, a lot of them are up over 4%. So you pay a massive premium, and obviously rates could drop and that floating rate could drop, but it'll unlikely to drop through that 2.5% range. So look, fixed is cheaper, that's key. The big reason people go for fixed though is that it gives you certainty of where you're at. And you're budgeting week to week, everyone sort of gets paid roughly the same in most cases, week to week, month to month. So you can budget on the fact that your payment's going to be a certain level because your interest is fixed. When you do fix that rate, we'll review it for you. So let's say we take 12 months fixed. Look, in 12 months time, we'll have a chat to you. We'll say, hey, look, should we be fixing you for another 12 months? Maybe 2 or 3 years is an option. Maybe we can play with your structure a bit from there. And that's where the floating comes in. If you've got the ability to pay some lump sums, you should have perhaps some of your loan on floating. And that means that if you get a bonus in each month, or you like that to come into some cash, you can still fix the majority of your lending, but have a separate loan that's on floating. You can use that portion there just to dump a little bit off as you go. No penalties at all for doing so, and you don't get those break fees. So the fixed rate does have a risk of getting break fees. If you are selling or you're looking to repay your loan while you're fixed, you will have to pay a break cost to some degree. And the big one we get is rate envy. When the rates drop, people go, oh, I want that new cheap rate. And then you've got to pay a large break fee to get off the rate you're currently on if it's a lot higher than the other rate. So look, it is good for certainty, but it cuts both ways. And look, we find for most people fixed is the way to go, but you need to tailor your structure to have a little bit of floating if you're going to be paying lump sums. As always, everyone's situation is different. But that's a brief rundown on the difference between fixed rates and floating rates. And look, we'd love to chat to you about which one's going to work for you, what term, what structure might help you to get debt free faster or just make things easier on your mortgage. So we look forward to hearing from you.